Hello, everybody. This is Practical Money, the show where we chat about investing and savings and taxes. Just a couple of guys sharing some of their thoughts and things they've done in the past. We're your hosts. I'm Jack Farmer. This is Raj Giri. Raj, how are you today?
I'm doing well, man. How are you? Happy holidays.
Happy holidays. I'm doing great. I just had some hot cocoa, so I'm feeling good. It is the holiday season. I actually have some fun news to share with you, by the way, though.
Aha.
Didn't
Let's
tell
hear
you
it.
any of this. This is just right off, just letting you know. We did a few episodes, and just like everybody else, I'm not perfect financially. I learned some things. I learned some things from you, and I took personal action after our show. I went and I got a new savings account with a better interest rate. Also, one of the things that has just kind of been a to-do item that I needed to do for a while is I had a credit card, had a balance on it because I use it for buying things for my own personal business, and it got racked up a little bit over the pandemic when there wasn't much work. And I said, you know what? Why do I keep this on a credit card? I'm just going to get the consolidation loan, get the lower rate. I did that, locked in a lower rate. Credit cards cleared off. Now I can start paying that off and get all that worked out. Raj, I'm on the show and I learned something.
Hey, man, I need a little commish here. That's great.
That'll be the that's the goal someday. But for now, so look, even though we're on the show, I like to share that because even though we're on this show, I think something that happens with people's money is people put stuff off and like, oh yeah, I'll invest later, I'll save later, I'll do this later, and sometimes eventually later you're like, hey, I haven't started yet. And I hope shows like this get people like me to go, I'm just going to do it now and start making things happen now. And I did it. I did it myself. I'm not perfect, Raj, but I got things squared away.
Hey, man, taking those early steps, those are the most important. That gets you, on the path to financial independence. So that's awesome. Yeah, that's great to hear.
So we're talking about something today, and I'm really eager to talk about this because it's something that I've been wanting to have a conversation about with for a while. Before we do, though, I should say, like, comment, share, subscribe, 5-star review, all that stuff with the show if you're watching it. If we appreciate it, by the way. Also, in the comments, and this is one of the big things, leave a comment with some of the questions you have after watching the show or some of the things you learned, maybe some of your successes that you've had from watching the show. Also, questions that you have that you'd like us to chat about. I think that'd be great to do. But most important is that old disclaimer is that this is not advice. This is not, we're not telling you what to do. This is just us talking about things we've learned and what we may or may not do if we were in different situations.
Yeah, absolutely. And everything I discuss is stuff that I am personally doing. And so with, today we're discussing tax loss harvesting. This is stuff I did. I sold some of my losing stocks and there will be a tax benefit. It'll offset my capital gains and yeah, we'll dive into it. But yes, this is all stuff that I do. I can't say it's best for everyone else. Everyone's investment goals are different. And this is just stuff that has worked for me.
So, Raj, I'm really excited to chat about tax loss harvesting. I signed up for a company called Wealthfront a while back, and it's one of these auto investor things. And I didn't know what it was. I just put some money in it to see how it would do. But they always talk about their tax loss harvesting and how it's helpful and it's going to help me save a ton of money. I don't really have a huge understanding of what tax loss harvesting is, though. Can you kind of explain it for someone like me who's heard of it but doesn't really know?
So I personally, I only use it for stocks. I don't use it for bonds just because stocks are more volatile. And it's basically, it's a strategy to sell investments that have lost money to reduce the amount of money you'll owe for taxes. And in the most simplest form, that's what it is. So basically you're selling your losing stocks and before the end of the year. So, when we're recording this is the 21st. So we got 10 days. You sell the losers, write off those on your taxes, and then you could use those funds, at least that's what I do, use those funds to invest back into the market. So you're still staying invested. If the market's down 40% and you're selling some stocks that have lost money over the past year, using those funds to buy other stocks that are probably discounted right now. It's a strategy that a lot of investors use. It's something that I didn't do for the longest time, just because to me, you're selling at a loss, and that's the opposite of what you want to do with investing. You want to buy low, sell high. But there are times when that's not the best strategy. And this is a strategy that a lot of investors use. And the more I read up on it, the more it made more sense.
So if you're someone who theoretically, let's say 6 months ago, you go, I'm going to buy a share of Tesla because they're building cars for the future, and their CEO is just one of those guys I can't imagine doing anything to embarrass himself, at least not in a public space. So you buy their share, and then 6 months go by, and now it's valued at half of what you bought it for. Not only could you sort of say I am jumping off the Tesla train theoretically, but you could take the money you lost in that and use that to save money on your taxes. Correct?
Correct. And there's a couple different ways to do that. So before we get down to the nitty gritty, this isn't the most, the sexiest topic or anything like that. But, Tesla is a good example. If it's one of those that if you feel like that is probably going to drop farther, then you can sell it. You take the loss, and then you could use it to buy, another EV company if you want. You just can't buy the same company. You can't. I mean, you can buy the same company. You just won't get the tax break. So if you sold Tesla and then bought it right away, you're not going to get the tax break. But if you sold Tesla and bought Rivian or some other auto EV or anything, you could buy Coca-Cola, whatever you want to use those proceeds to buy. But you can write the losses off on your taxes.
So if you were to say, so it's kind of a double win, making a loss a double win in a way, because you're losing on the stock, but you sell, so you get the money that the stock is valued at that point. You can then buy something that you think is going to go up, but then you can also write off that loss. It's kind of making the best of a bad situation if it happens.
Absolutely. And there's different strategies that people employ, but I'm going to use a simple example to start off with. And that's just let's say you bought $10,000 in Exxon earlier this year, and today it's worth $15,000. Mm-hmm. So if you sold the stock, you have a $5,000 profit, and you need to pay capital gains on that $5,000 profit. Now, let's say you had bought $10,000 in GM stock, and today it's worth $5,000. So you lost $5,000. If you sold it, that's a $5,000 loss on your GM stock, and that would completely offset the $5,000 that you made on Exxon. So basically, your taxes are wiped out by utilizing this strategy.
So if to kind of put it into perspective, with just the Exxon, I bought it for 10. It is now worth 15, and I sell it. I made 5,000. Of course, Uncle Sam's going to want his cut, and let's say theoretically, it's 20% is the tax. I don't know what the tax rate's going to be. Everyone's different, and I can't even do the math that quickly right now. What's 20%?
Let's say it's 35%.
Let's say it's 35%, which would make 35% 5,000 would be what is that, like 1,000?
It's like 15, 17. So
let's say 1,500. So let's say they want to take 1,500 of it. I didn't actually make 5,000. I really only end up making 3,500 because I got to give 1,500 to Uncle Sam. But if I sell that GM stock, that wipes that away, and I get to keep the 1,500 theoretically in this situation.
Exactly. Yes.
So it's and if you have a stock, if this stock that you're selling that's at a loss, let's say it's again like an AMC, where I don't know if AMC is coming back. I don't know if it's going to bounce back. And again, I'm just picking AMC out of a hat here.
Right.
But if I'm like, I don't really know if they're coming back, then there's no point in holding on to it anyways. I might as well cut my losses and save some money on something else in the meantime.
Absolutely. And, some of the stocks I sold this year, I sold Mara, Marathon, Palantir, Zoom. There is a lot of times I'll buy certain stocks in a bull market that I think are going to jump up higher and higher and higher. But when we're in a bear market, you lose money on them. And we're not going to get, in my opinion, I don't think we're going to get back into a bull market for a little while. Mm-hmm. So sell those, just put my money, take those, I put it into an index fund and more into some of my other positions. And and I get to write those off against my capital gains on my taxes. And now let's say let's say that you don't have capital gains, that you didn't make money on stocks, you still get a tax benefit using tax loss harvesting. So you sell your losing stocks, you have no profits. What the IRS allows you to do is take another $3,000 deduction of the loss to lower your ordinary taxable income, if that makes sense. So if you lost 5,000 in stocks and you sold it, you lost 5,000 on your taxes, you could write $3,000 of that off this year, and the remaining 2,000 you could roll that over into another year. And so you still get the tax benefit of the total amount of your losses. It's just only 3,000 would be this year, and then the remaining amount would roll over to subsequent years.
So it's something that you can actually, the rollover thing is big, because that means even if this is a year that maybe I don't need the deduction as much, or I don't have that much I'll be able to offset, I can still use it. It's like a cell phone plan where you get your minutes rolling over to the next month. Do people have minutes on cell phones anymore? I feel like that's not how it works anymore. But
I don't know, maybe
someone out there. But basically, it's like the rollover is a big deal, because you don't need to necessarily worry as much about, did I lose enough money on something else or make enough money on something else, because you can just roll it into the next one anyways. And so
right. So kind of keeping with that, the example we had earlier, let's say you bought $10,000 in Exxon earlier this year, and today it's worth $15,000. So you got the $5,000 in profit. Let's say you bought $20,000 in GM stock, and today it's worth $10,000. So you lost $10,000. You have a loss of $10,000. 5,000 of that loss will offset the taxes from the 5,000 profits from the Exxon sale. So that wipes out any taxes you'll have to pay on the money you made from the Exxon sale. And then you're still left with $5,000 in losses. You can use 3,000 of that to lower your ordinary taxable income this year. And then you still have that remaining 2,000 that'll move on to another year.
And some of these things we're talking about, not this necessarily for everything, but this is, I think, where people will read online about someone who has a ton of money but didn't pay any taxes. It's because they've used these kinds of things to offset losses and save money on their taxes.
Right.
Again, this isn't the only thing. There's a lot of things, but this is one of those kinds of things that you go, this guy made so much money, how come he didn't pay taxes? This is it. This is one of those things.
Yeah, the rich, they use, strategies like this all the time, but it's one of those things that it's available for everyone. And so, and I have this little thing at Charles Schwab that I'll share real quick, and it shows using an investment loss to lower your capital gains tax. And I'll link to this in the description of the video, but it's showing you have a investment A, investment B. Investment A, you got $20,000 in capital gains. Investment B, you got a $25,000 capital loss. And at the end, your potential tax savings are $8,050. So it's pretty significant. And again, I'll link to that. But once you do the math, the tax savings can be very significant.
And even if it's one of those things, even if you don't have $25,000, even if it's a smaller amount, I think one of the running themes of this show is small amounts add up to big amounts. And if you can save small amounts, those are the difference makers in what puts you ahead down the road. And to just make good habits with this kind of stuff. So
right. And you mentioned Tesla earlier, and that's one of those stocks that I bought into Tesla early. So if I were to sell it, I'd have a lot of capital gains on it. And so this would be a way to offset all the capital gains that I would have on Tesla. And I offset those, and I also get rid of a stock that if I believe it's going to keep going down further and further and further, and then down the road, I could always repurchase it.
Right. And it's something I think stocks are a risk. I don't want to say that anything is risk-free, but knowing that you can invest, I think some people get worried, like, what if I invest in Starbucks and Starbucks goes out of business tomorrow? I mean, one, they're not going out of business tomorrow, but two, there are options for you if that happens to help mitigate some of your losses and those kinds of things.
Absolutely.
So just dive in and get some. Again, I'm not an advisor, but
it's worth looking into. And and I'll link to other websites and stuff that have more on this. again, do your own research, speak to your financial advisor and accountant if this is something you're interested in. But it's something all the big firms do. If you sign up for their professionally managed accounts, that's what they're doing. They're doing tax loss harvesting. They're writing off the losers, buying winners, and taking those tax benefits.
And so definitely look into this. Now, again, we've talked about IRAs and things like that in the past. One thing, disclaimer here, is obviously these stocks can't be a part of a something like an IRA that is making it non-taxable.
Right. Yeah. Tax loss harvesting can only be done in taxable accounts. So not in IRAs, 401ks, and things like that. And there's some other rules too. The big one is a wash sale rule, and which the IRS has, which means you can't sell a position and take the loss on your taxes and then buy the same or substantially similar position 30 days before or after the sale. So what that means, like I sold Zoom, I can't just go back, take the tax write-off on Zoom, and then buy Zoom right away.
Right.
And,
at the same price you sold it for, and get right back in where you were.
Exactly. And similar, and they say a substantially similar position. So similarly, I can't sell like an S&P 500 index fund like IVV and then just right away go buy another S&P index fund like VLO.
Right.
Because they're substantially similar. And so you can do it, you just can't get the tax write-off on that. And so unless I wait 31 days, so 30 days before, 30 days after. So if I sold Zoom, I waited 31 days, then I could buy Zoom again and still get that the tax benefit. Now, there is one thing, you can buy very similar, just not substantially similar, if that makes sense. I can sell GM and buy Ford that same day. And they kind of had been tracking similarly this year. Similarly, I mentioned VOO, which is a S&P 500 index fund. I could sell that if I purchased it earlier this year. I got a loss. I can sell that, get the tax benefit, and then buy a total market index fund like VTI. So they're different enough because they're not the same thing, but they're also still kind of tracking. They kind of have the same performance over time or similar performance. So that is something you can do.
So yeah, they can be similar, but not too similar. And that's probably somewhere where you want to get the tax advisor to help you out.
Right. You can't buy like Google A shares and sell it and buy Google B shares.
Right. Where different car companies can have different performances, even though the auto industry may be similar.
Right. Exactly.
So a lot of interesting stuff there. This is one I'm very curious to see what people in the comments have to say. So if you have any questions about this, definitely let us know in the comments. If you learned something, let us know. If you're going to try something, let us know. I would say at the very least, make sure to talk to your tax advisor and see what they have to say. And this is another one of those things, Raj, where I think just knowing where you're at, knowing what you have and what you don't have and where money's coming and going, so that when you do get time to do taxes, you kind of know what you have instead of just saying, here's my tax return, I guess I'm taking what I'm getting.
Right.
And last thing here, just to make sure everyone's clear, if I buy a stock, stock ABC, I buy it for $1, it goes up to $10 and then goes down to $9 and I sell it, I don't get to write off that $1 because I'm still up. It has to be from where you're at. So just because the stock went down doesn't mean you're at a loss yet.
Right. Yeah. If you bought it, exactly. If you bought it at $9, it went down to $1, then you can, then you could write off the losses. But yes, if you 1 to 10, then down to 9, you still off that $1 investment made a pretty big profit.
Right. Yeah. At that point, you should just be happy. Right. Pretty good returns.
All right. Yeah, exactly.
But I think that does it for us. As always, these videos are not investment advice. So if this is a strategy you're interested in, do your own research and speak with your financial advisor or tax professional. We will have some helpful links in the comments or in the description below. That does it for us. Raj, thank you so much for this information and some last minute to-do items for the year.
Absolutely. And I know in the last video, we said we're going to discuss my favorite investment in this video, but because this is kind of in a time crunch, we figured we'd do this first. And then, we'll get back to my favorite investment here in a couple of weeks.
Yeah, so that's a tease, ladies and gentlemen. That means you got to stay tuned. Maybe put some guesses what you think Raj's favorite investment is in the comments. We'll see how those come out. But again, thank you everyone for watching. Like, comment, share, subscribe. Especially as we start this, sharing is so important. So if you like what you see, just copy the link and plug it into social media and tell everyone else to take a look. I think that does it for us, Raj. Thanks so much for your time and happy holidays.
Happy holidays to you too. Merry Christmas.
Merry Christmas, and we'll see you guys all next year.